I recently met with somebody to discuss their tax planning concerns, and when I took a look at their situation, I noticed they were dealing with not one but two common and painful tax problems. They showed me over a decade of self-produced spreadsheets and projections, but you know what was missing? Assumptions on how bad the taxes could get. In many ways, they were having a successful retirement, but the impact to their bottom line after taxes was only getting worse. In this video, we're going to discuss two common tax bombs that I see all the time and what tools exist to help you diffuse them. Hey everybody, I'm Curtis Crossland of Suttle Crossland Wealth Advisors. I help folks build more tax-efficient retirements, so let's get into it. Now to some, the reason this matters may be painfully obvious, but to others, if this has not come across your radar yet, the more that you pay in taxes in retirement, the less that you get to spend and give during and after your lifetime. And when it comes to income recognition in retirement, it feels as if the current system is geared towards maximizing tax revenue off of everybody. And I want to make an appeal to you to think ahead on your tax planning, so stick around to the end where we'll see a quick example of this at work. Now, the individual that I was speaking with, they were dealing with the first common tax bomb, and this was the havoc being wreaked by the required minimum distributions. The way that their retirement shaped up, they didn't really need to touch much in the IRA, and so their balances simply ballooned over time. This didn't seem like an issue initially, but now they're at a point where their required minimum distributions are much higher than they anticipated and their options are more limited. And this is something I often see for retirees that are at RMD age. When you first retire, you may not have a pension or Social Security rolling in yet, and those interim years, your late 50s and early 60s, can correspond to owing little to no tax. You're out there partying on the golf course or pickleball court, and the years can start to fly by. Before you know it, you're past 70, your taxable income is exploding, and you're climbing up that tax bracket. And for this person, their situation was further compounded by the second common tax bomb, and that was the fact that they are a widower. And this is one that we never like to think about, but it can come with a painful tax increase. You may have heard this referred to as the widow's penalty or widow's tax trap. This occurs when one spouse passes away and a surviving spouse sees their tax bracket squeezed from being a married filer to a single filer. And to make matters worse, added surcharges and costs can also start to hit at lower levels, things like Medicare's IRMA or even net investment income tax. If you don't know what net investment income tax is or simply want a refresher, I did make a video on that topic. I'll put a link to that down in the description. Now here's a look at the tax brackets for 2024 side by side, and you could see there's a pretty big difference between when a single person moves from the 12 to 22% bracket and when a married couple does. So imagine you're now a single filer and perhaps you inherited your spouse's IRAs or 401k accounts and you're in required minimum distribution years. Between Social Security, perhaps a pension, maybe large required minimum distributions, you might be required to take out far more income than you need to live on and suddenly feel trapped with the amount of taxes you're paying. Well, let's discuss the tools that are available, and then again, stay with me so we can take a look at that example of a couple of these in action. Now, there are different tools that exist that you could consider for pretty much any situation already. Those would be things like, tax-efficient investing, trying to maximize deductions, etc. But I want to focus on what I see as two of the biggest. The first and perhaps biggest tool that you would have would be low-income years and early retirement. I'm speaking to those individuals that are late 50s, early 60s, or even younger if you see this as a looming concern. Setting yourself up so you can run a tax avoidance strategy means you need to have time, low income, and assets to facilitate. All things that you can plan towards, but being able to use these low income years for strategic income recognition can be huge. Now, I know some of you are going to hear this and say, well, I'm already past my 60s or I have high income. Well, not all hope is lost, but for those individuals that can put themselves in a position or find themselves in a strong position in early retirement, can work to diffuse the looming tax bombs that are coming. This can mean utilizing Roth conversions, taking money from IRA sources, or some combination of both if it makes sense. Let's work through an example. Let's say you contributed $10,000 when you were in the 24% bracket while working. Your federal tax savings on that $10,000 would have been $2,400. But if distributed at a time when you were subject to lower rates, say 12%, now you only pay federal tax of $1,200. And the principle at work here is based on tax arbitrage. You essentially saved on federal tax by deferring when you were in higher brackets and then later paying the tax when you're in lower brackets. The beauty part of this approach as well is it can actually help to lower or diffuse both of the common tax bombs that we've been highlighting. High income due to required minimum distributions and the squeeze that can occur on tax brackets related to the widow's penalty. Now, this approach can get technical. It requires a lot of vigilance. And any time that you look at tax planning, this is a point where you have to decide if you have the tools and know how to do this. And if not, seeking the help of a qualified professional might make all the difference. But this golden window doesn't stay open forever, and there are trade-offs. If you're intentionally trying to keep your income low to qualify for certain credits, well, that's a trade-off. But targeting a threshold to stay within is a big part of this approach to help avoid surtaxes, so a lot of care is needed. And this leads to the second tool I want to highlight, and that is qualified charitable distributions for those that are over age 70 and a half. This allows an individual who is, again, over 70 and a half, and the IRS definitely stresses that age, to gift up to $100,000 a year from their IRA directly to a qualified charity without having to recognize that income. And this also counts towards required minimum distribution requirements. And for a married couple, this means that each spouse can actually give up to $100,000. On a side note, you can always give cash, investments, or other assets if you're working towards itemizing deductions. I'll put a link to the IRS's deduction limits down in the description. And as a rule of thumb, discuss anything tax related with a tax advisor before you consider doing anything. So now let's move on to a quick example. I want to show you a couple of these things in action and hopefully drive the point home. So here we are in our example. We have two of our favorite crash test dummies. We've got Joe and Jane. So here we can see a little bit about their net worth. We see that they do have a fairly healthy amount in their retirement account. See Joe's IRA here. We can look and we can see Jane's IRA here. And then past that, they do have other assets. We can see that their bank account has $75,000 in it. And we can see that they have a taxable brokerage amount of about $410,000. Total net worth just over $2.2 million. We can also see their ages here, 59 for Joe, 58 for Jane, and they are now retired. And this is kind of the recipe for somebody that would have an opportunity to look at trying to diffuse those RMD or the required minimum distribution tax bomb that's coming later. So we'll actually come up here and we'll take a look real quickly at what some of their goals are going to be for retirement. So we see that they want to spend $6,000 per month. And at least right now, we're going to have the charitable giving at 0. But we'll come back to this one later so we can see that second tool in just a bit. And we'll notice as well, there's no additional pension. So they're basically trying to make retirement work on Social Security plus the investments and savings that they have. So when I come over here and we take a look at their cash flows, right here in this tax payment column, we can see how the tax payments escalate over time. Their age over here on the left, the estimated tax payment over here in this column. And as we see them getting older, we see that tax payment kind of steadily getting higher. And then at some point we can see right around age 75 for both. Now we start to see an elevation or an increase as it relates to things like the required minimum distribution. So you've got income sources from Social Security, you've got income sources from required minimum distributions. There may also be income sources from that taxable portfolio, and that's where we're seeing this tax payment, again, escalate a little bit year over year. But it's the idea that if you can make a change to each year for a larger number of years, that is what we're after in terms of trying to diffuse the tax bomb. So we'll actually come up and we will come over and now take a look at what this is going to look like in their situation. And I want to pause and just say that this is just an example. This is not going to be dogma or something that everybody absolutely is going to be able to do or take advantage of. Take everything with a grain of salt. This is not a crystal ball, but it's about as close as we can get in terms of projecting what might happen. Now, for them, the real question is, well, what if we do nothing? So if we do nothing, we can see that a lot of the tax in the shaded blue area is really going to start to come in at this point here once Social Security begins to pick up. Eventually, they're going to hit that point where required minimum distributions pick up. And then they're going to have a very long stretch of time where these yearly increases are really going to start to escalate the aggregate. So if we take a look at the option of trying to diffuse the tax bomb here, now we can look at the difference of, well, what if we try to strategically use these years up here? You know, these late 50s, early 60s. Well, visually, you can kind of see a difference. The green area, this is what would happen if they were to do a Roth conversion strategy going up to the top of that 22 and 25% bracket. The 25 is just in relation to when the Tax Cuts and Jobs Act is supposed to sunset at the end of 2025. But here, visually, we can see pay a lot of taxes up front. You know, you compare that versus the blue section, which is to do nothing and essentially live your life and wait to pay all the taxes as they occur. But you can see visually there's a much larger shaded blue area for more years than there is a shaded green area, which we can see for less years. So real quickly, what does that look like? Well, essentially it looks like them working with their tax professional, with somebody that can help them with their tax planning to figure out a safe amount to convert, pay the tax, use those assets that they already have set aside to do that, pay that tax now in an effort to reduce or diminish the amount of IRA balance so that when they hit age 75, they are not required to take out excessive amounts of income compared to what they need. And in some situations, you could run into a scenario, and we may actually see that here, where if you do enough work up front, potentially you could convert entirely away from the IRA account over a course of years. If they have no IRA, if they have no pre-tax accounts, there's nothing that they're then required to take out. So let's look at a comparison. And if we come over here, a couple really important things to note. For them, they would be in a scenario where they could convert enough over a course of years to get their ending balance to actually be pretty much all moved over to tax-free or essentially Roth. Now that would come at the expense of, again, paying taxes early, likely using and cannibalizing the taxable account first. But by doing that, they were able to transition the makeup of their assets from a very large amount of pre-tax or IRA over to Roth. So we can see that doing the conversion 100% towards tax-free. And so maybe as a secondary goal, if you think about legacy, imagine leaving something to your family. You know, the balance amounts here, whether they do conversion or not, are roughly the same or very close. But what about leaving assets to specifically individuals or family? What if you could give them a tax-free inheritance? You know, versus an IRA account that they may have to distribute within 10 years, and that might be when they're maybe in peak earning years, or maybe they're dealing with their own required minimum distributions, and now their own tax problem is ballooning and spiraling even further out of control. But this is probably a good time to talk about some of the trade-offs. If you strategically realize more income in low income years, that may mean you can't have as much benefit on something like the ACA health plans, you know, getting those credits. That might be important to you if you have a lot of health needs. Doing a conversion strategy that cranks up your income is something that would work against that. So that's a trade-off. Maybe you still are eligible for certain credits, kids in college, maybe the, lifetime learning credit, some of these other credits that are kid related. There is a chance you could phase out of some of those ranges by having a very high income because of a strategic approach. So you have to try to understand what the trade-offs are, and then for your own situation, you have to decide if those trade-offs are going to be worth it. So let's take a look at a couple of the other keys here. And this one's kind of fun. At a certain point, they're still going to need money, but most of what they are going to be able to take, and we see this light shaded blue section is tax-free. Basically, this is them taking money from the Roth IRA and not having to worry about how much of that is going to be taxable. Is that going to push Social Security up into the tax torpedo range, or is that going to change certain aspects of their tax bracket? Looking at the balance, again, imagine leaving this to individuals and family. A tax-free legacy, something that they might be able to let stay in an inherited Roth account for 10 years before having to distribute, getting an additional 10 years of tax-free growth. Versus over here, where most of what you're going to be leaving would be an IRA account, which would be something they would have to deal with in terms of the inheritance laws as they are right now. Looking as well, you tell me which of these charts looks better to you. At least in this instance for these folks, a $0 required minimum distribution versus a required minimum distribution that continues to escalate as they age. And this is part of what also makes the widow's penalty so painful. And then the best one to maybe look at is right here. And again, take this with a grain of salt. On the left, conversion for these folks gives them an estimated federal tax payment in total of about $300,000 versus almost $700,000 by doing no conversion, no strategic use, just living their lives and taking it as it comes. So now let's take a look at what happens if we have a spouse that passes early. And to do that, we're going to come over here and sorry, Joe, the fates have conspired against you. You are going to pass away at 70. And then Jane is going to continue on and live to 90. Now, one other thing that tends to happen is down here. Spending is probably going to fall off when one spouse passes away. And so what we will do is we will say, okay, Joe passed away at 70. Jane continues on to 90. Spending has a little bit of an adjustment just to make up for that fact. That's pretty typical. What happens now? Well, let's take a look. The only thing that happened was Joe passed away and Jane likely had a little bit of a reduction in spending. And because of that, we see this number. Remember before it was just over 690,000 or just under 700,000 on that federal tax estimate. Well, now it's over 870. So this is the widow's penalty at work, effectively squeezing those brackets on Jane. So what's interesting is that the fix for this is the same as it was for the other one. Running the strategy where we basically have the conversions or strategic use of the account. And we have the same estimate over here because at least in their situation, they were able to fully convert IRA dollars before 70. In this instance, diffusing both of those tax bombs has an even bigger savings potential to Jane. So if you find yourself in a situation where this type of tax planning might make a difference, figure out if you are in that position. Now, if you're past those years, not all hope is lost. Let's take a look at a quick example in terms of the charitable gifting aspect and see if that can have an impact or a difference. And so I've come back over here. I am unkilling Joe. Welcome back. Now we're going to go take a look and see what happens. And we'll look at just a small example. What we'll do is we'll actually come over here, back over to where we were talking about that charitable gifting before. And let's change this amount to $25,000. We'll have him do a one-time $25,000 gift to charity. So back over here on the cash flows, we'll come down and we'll take a look right here. Age 76, we see that $25,000 gift. We see his tax payment for the single year. We'll keep this number in mind, $18,646. What happens if he doesn't make that qualified charitable, but he's still in those RMD years? Well, here we have it. 76. Instead, his tax payment is about $5,000 higher. So even if you're past RMD age, even if you already have pensions, even if you already have some of these other income sources, ownership, rents and royalties, dividends, etc., qualified charitable distributions can still have an impact on the tax payment. So there are going to be tools that can be used to help folks even when they are past. But if you're in a position to be able to look at that first tool, those early retirement years and the right recipe and setup, it can be a powerful tax planning tool for those folks that are entering retirement or about to. I'd love to know if any of these numbers surprised you. And I know I didn't cover every single tax bomb that exists, but let me know what tax bombs you've had to deal with and what made a difference. And if you have any planning topics that you'd like to see me cover, feel free to share those as well. Once more, I'm Curtis Crossland, and if you want to see how we help folks build a more tax-focused and efficient retirement, be sure to check us out at SuttleCrossland.com and subscribe for future videos.